Well, hi everyone, and welcome to the Buffett and Beyond Research Saturday Stock Market Recap, May 16th, 2026. And remember, folks, if you want to live or walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And the market, well, it was a perfect week right up until Friday, and the price of oil went up as well as some interest rates, and the market went the other way. And we'll have to wait until this coming week to see if those technical indicators we follow will go through a reversion process to the mean. We're talking about the 20-day moving average right here. And our weekly stock analysis video, well, NVIDIA jumped this week, which brings its 5-year returns up over 1,600%. Wow. So when does this stock get too expensive? Well, we talked about it this week during our weekly letters, and it's not as expensive as some of those other semiconductor stocks out there, and it's really not that expensive at all, except for a bull market. And for bringing in over 1,600% over the past 5 years, it's not expensive at all. And our ETF video, well, our top portfolios. Now, these are the stocks that we pick out of ETFs or indices that we think are the above average stocks, so we can outperform that ETF or that index. And our top portfolios are outperforming nicely. Our growth portfolio is almost doubling the S&P right now, while our semiconductor top stocks are up over 40% year to date, and our top tech stocks are up over 30% year to date. So folks, you want to see this ETF video. And let's look at the 5-year returns of over 1,600% of NVIDIA, just to whet your appetite, and check out what we said about the valuation on this stock in our daily letter this past week. I can't remember if it was Tuesday or Wednesday or maybe even Thursday that we talked about it, but it was one of those days. Look in our archives and you can see it. And let us look at the S&P 500. These are the Bollinger Bands, or better known as volatility bands. And yep, we hit that top, didn't break through it, finally closed below it on Thursday, and now Friday, and the market's not closed yet. Friday, the market is down, and the S&P is down 66 points at this point. But like I said, it's Friday afternoon. The market has not closed yet. When we come down here, we look at this indicator. Is it rolling over to the downside? Well, we won't know until Monday or Tuesday. And when we look at the indicators again, this top indicator looks like it's coming down, but it did that before in here just a little bit for a day or two. We had a drop in the market for a day or two, and then it resumed its upward swing, and now it's starting to maybe come down a little bit. And we come down here to the 20-day moving average, and this is what we mean by reversion to the mean. You can see that it's getting close to that 20-day moving average, and then we'll see what happens if it can hold that 20-day and then bounce up again. But that's a very, very important point at this point in time right now. And down here we can look a little closer and see, yeah, it looks like this black line is turning down, but it did it back here also. And the market just went up from there. So we just have to say the S&P is up about 8% so far this year. Our growth portfolio was up close to 16% this year. So we're doing quite well over there with that growth portfolio, which we usually do. We usually outperform the S&P most of the time, and over 23 years have outperformed it almost 3-to-1 on a compounded basis. So this is a very, very good portfolio, very good methodology of selecting the above average stocks. Is really what it's all about. And let's see the SPY this week. Well, we bought some protection because the May puts way back here expired, and we went out and we bought some August puts about 15% below the market. And right now, as I'm recording this, the SPY, which is 1/10 of the S&P 500, is up 3 points this week as I'm recording this on Friday afternoon. And the QQQs, 7-Eleven, they're up 3 points also. And we went out and bought the August 21st 625 puts, about 15% below the market. And we use that for protection. And some of you use this, a lot of you do. But you don't buy as many as you need to protect the entire portfolio until we get some serious sell signals. And when you're looking at for a $200,000 portfolio, you spent about almost $500 in here, and we're saying, okay, is that too much for protection or not? And like I said, a lot of you wait until we get some definitive downside movement before you go into these, and some of you have one or two of them all the time in your portfolio, just in case something happens. So it's all up to you how you want to protect that portfolio. And over time, we've probably used these puts maybe 3, 4, 5, 6 times over the past 20 some years. So is it worth it or not? It's all up to you and how you want to protect your portfolio. Those of you who have used the protection up all the time still return as much as the S&P, but now you have a portfolio that's protected about 12 to 15% below the market. And if the market falls more than that, you're totally protected. So that's the kind of give and take that you have to think of. If you have a superior performing portfolio, you can afford to buy some protection and still perform as good or better than the S&P 500. That's what protection is all about, folks. And wow, a great week, but Friday is just knocking us off our feet a little bit, but that's okay. We're up for the week so far. You folks go out, have a good time, stay safe, be with your loved ones. Most of all, stay well. And folks, we'll see you right back here in a couple of days.